Well, one of the really big changes in Australia's economy has come as a result of interest rate rises from the Reserve Bank this week, plus also ongoing pressures on inflation, plus energy right across the country. Now, that's prompted Australia's largest bank to downgrade significantly its forecasts of Australia's economy, not just this year, but into next year as well. But it's not just as a result of overall economic growth, but indeed even house prices that have been revised downwards as a result of these latest numbers out. The head of Australian economics for the Commonwealth Bank is Gareth, who joins me now. Gareth, many thanks for your time. I mean, they are significant falls in where you were previously. GDP growth forecast to be 3.5% in 2022 from 4.7% previously, and certainly below trend 2.1% next year compared with a previous forecast of 3.1%. What exactly were the catalysts that prompted you to these forecasts?
Yeah, g'day, Ross. Look, the catalyst is simply what the Reserve Bank did this week and now where we think they're going to take interest rates. We expected rates to go higher. We had the view out there very early this year that we thought they'd be raising rates around about now, but we didn't think they'd go so aggressively. Having delivered 25 basis points at the May board meeting, the Reserve Bank this week delivered a 50 basis point increase in the cash rate, which caught pretty much everyone in the market by surprise. And I think they've changed their tune quite materially now. They seem to be very much focused on dropping the rate of inflation as quickly as possible, which means they're likely to deliver bigger rate rises as we go through this year. We think they'll do another 50 basis points at the June board meeting. They could potentially do another 50 at the August meeting as well, given the Q2 CPI will be very strong. So we're thinking now that the cash rate will end the year at about 2.1%, between 2.1% and 2.35%, depending on just how aggressively they go. But that has a big impact on the consumer, and it will have a big impact on GDP. So because we think ultimately the increase in the cash rate will be so significant, we've downgraded our assessment on the outlook for growth simply because households won't have as much money to spend, and therefore consumer spending will slow.
At your higher scenario, you say that the cash rate could even go to 2.35%, which would really be the equivalent of what's that 9 interest rate rises of 0.25% during that period of time, 0.5% we've seen now, but it goes on quite clearly. Now, that has an impact on the overall economy, and what you're saying is it doesn't necessarily break Australia's economy, but certainly the aggressiveness of those rate rises gives Australia's economy a shake.
Absolutely. I think growth in consumer spending will slow quite considerably with interest rate rises. It'll take a little bit of time to filter through, but I think by the time we get towards the end of this year, if they've delivered like what we're thinking in terms of rate hikes, I think the outlook has changed then quite considerably. We think as we go through 2023, then we're looking at below trend growth, somewhere a little bit over 2%. And in that sort of environment, the labour market starts to shift, and we think the unemployment rate will end up drifting up a little bit from over the second half of next year. And funnily enough, we've now got rate cuts in our profile for the second half of next year. Now, that might seem a little bit extreme given we're talking about near-term big interest rate increases, but we think what will end up happening is the Reserve Bank will put on the brakes on the economy too quickly, because they'll take policy to a contractionary setting in an effort to get inflation down. As we go through next year, then the economy slows quite a lot. And eventually, if the unemployment rate starts to go up, well, we'll be talking about rates needing to come back down again.
It's just incredible. So the other part about this, it clearly is going to have an impact on consumer behaviour and the overall economy, is your forecast for house prices. So say, for example, in Sydney, last year up by 25%. This year you say down 11%, and next year down another 7%. So a big fall. But it's Melbourne I want to go to. Last year up by 15%, but this year you say those prices will fall 10%, and next year by another 8%. In other words, it could end up being that Melbourne house prices end up being lower than what they were around about the pandemic when the boom occurred.
Yeah, and look, I think it makes a lot of sense given interest rates will be well above where they were when the pandemic arrived. You know, we went into the pandemic with a cash rate of just 0.75%, and the cash rate today is 0.85%. So we're already above where we were pre-pandemic, and we think there's plenty more to come in the way of rate rises given what the Reserve Bank has done this week. Now, home prices in Sydney and Melbourne have already started to fall. In Sydney, for example, they were down 1% in May, and all the Reserve Bank had delivered at that point was 25 basis points. So if they've done 50 now this week, we think they're doing a fair bit more. And the higher rates go, the more downward pressure that will actually put on home prices. So in many ways, the economic outcomes we get from here and the outcomes we get in the housing market are going to be heavily dependent on what the Reserve Bank ends up doing. And the reason we've downgraded our view on growth for the economy and downgraded our assessment of where house prices are going is simply because we think the Reserve Bank is taking the cash rate now higher at a quicker rate based on what they did this week. So, I would say the message in all of this is that the Reserve Bank is going to be heavily responsible for what kind of economic outcomes we get here. They're going to have a big say in where home prices go. And the faster they go up and the harder they go up, the bigger the impact will be. And the more chance there is that they have to come back down as we go through next year.
That's right. So I've spoken to the Treasurer just in the last day or so about the narrow path that the government and also the Reserve Bank are on. And if they get these settings wrong, they go too hard, too fast. And they're talking about this in the UK and the US. The economy has the threat of really tipping off that trail, and there could be a hard landing. Is that something that you're concerned about now?
It is because households in Australia carry a lot of debt. We're one of the most indebted household sectors in the world, and households have been borrowing lots of money at very, very, very low interest rates because through the pandemic, the Reserve Bank cut the cash rate, as we know, to 0.1%. They also put in a term funding facility, which meant the banks could give fixed rate loans at very, very low rates. Now, those rates will be expiring, and also anyone who's on a floating rate will be hit with rate hikes. And what we're going to see as we go through next year in particular is there will be lots of borrowers out there who are on a fixed rate of around 2.25% who will be rolling off onto a rate that's significantly higher based on what we think the Reserve Bank will do with the cash rate. So for a lot of households, they're going to experience a big increase in their mortgage repayments. And the way they're going to meet those mortgage repayments is to stop spending money on certain things, those discretionary items that they've probably been spending money on until this point. Now, the problem is you don't want everybody slowing their discretionary expenditure too quickly because suddenly that has a negative impact on the labour market. And we think the corridor where the Reserve Bank can raise rates and not take them too far is actually quite narrow. And I think they're going to end up taking rates that are a little bit too high, given they really want to push inflation down. And that's why we think as we go through next year, they'll reverse gear at some point and actually lower the cash rate because it will have turned out to be the case that the economy slowed too quickly. And that's not something that's desired.
I'll tell you, Gareth Aird, always good to have in the program. Thanks for your input today. The head of Australian economics at the Commonwealth Bank, Gareth Aird.
Thank you, Ross.